We spend a lot of time on this podcast and in the office being bullish and seeing the best in markets. And I think it's a good exercise every once in a while to take a step back and reevaluate what are the risks out there that we're either not concerned about now or have dismissed or maybe aren't giving their proper due. So in today's episode, we're going to review the risks that we see in the markets to 2025 stock returns. I think a lot of these are worth keeping an eye on over the next year. I don't see a lot of them being immediate headwinds, but we'll get into it and evaluate.
Yeah, I mean, I think the half of our job, besides just picking what we think are the best companies and the best areas of the market to be in, the best asset classes, is you always have that counterbalance of what the risks are. We always have to pay attention to risk because whenever you're talking about managing someone else's wealth that they've accumulated over their entire life, the risk part is more important than the potential upside. So I think it's going to be interesting today to kind of look through some of the risks in the market, at least what the market's concerned about that we are more or less concerned about in some circumstances. And we've talked about this on prior podcasts. People should check out our podcast on market valuation about this one. But the S&P 500 market valuation right now is what would be historically a little bit expensive. So that could be a potential risk to markets. We're trading in that 22 to 23 times forward PE. Now we're a little bit less concerned about that because of the underlying market dynamics involved, the growth trajectory of companies warranting that slightly higher valuation. And like I said, we explain that in depth in our other podcast. So it's worth checking that one out if you're interested. But I think that is, can be considered by a lot of risks. Certainly a lot of the talking heads on the news networks are mentioning market valuation being expensive. We think this market's fundamentally different than, say 20 years ago, but it's something to call out as a risk that people are paying attention to. I think at least for us, this is a little bit less of a concern, but certainly you do have a little bit higher trading valuation than sometimes in history.
And it's certainly a reason to that we're happy with our approach of individual stock ownership, individual stock selection, because there are some overvalued companies in there. Again, if we're talking in aggregate, I don't know that I'm so concerned about that, but being able to avoid those individual companies that are contributing excess, price to earnings valuation to the S&P. Yeah, I think that's a, great place to be. And then similarly with that, but on the fixed income side, a risk that I think is worth pointing out in fixed income, something that people aren't really focused on as being a risky part of their portfolio, because usually that's your risk off category. But credit spreads right now are really tight, meaning you're getting compensated very little for taking corporate debt versus US government debt. And so that extra compensation is not very much. So if there's any kind of degradation in economic activity, that could really affect your return on these bonds, even without them going under or defaulting on their debt or actually missing payments. But just the price performance could, move against you pretty hard just because the economy's weakened or, whatever it may be. But, you're not being compensated for that risk you're taking on right now.
Right. I don't really like this term necessarily, but a lot of people call that, price to perfection, where you're not contributing a lot of risk to those corporate bonds. So with the spreads being really tight, like you said, it does open you up to potential like negative price movements, even if interest rates kind of stay in similar range. Now, talking about interest rates and fixed income, we have to talk about the Fed, what they're doing with interest rates, because this continues to be the primary market driver beyond, say, earnings on an individual company basis. But the big macro driver continues to be the Fed, continues to be what is the interest rate trajectory. Well, obviously, we got a final rate cut in December of last year. Now we're talking about a really interesting kind of interest rate environment going into 2025. We don't really know when the next interest rate cut is going to be. They're almost certain to skip the January meeting. Now, when will the first rate cut of 2025 be? Well, the question has changed a lot over recent weeks, just because the Fed came out with their summary of economic projections showing that they expect 2 rate cuts of 25 basis points or 1/4% this year. Now, market expectations have even shifted somewhat below that. So the market's really only expecting, somewhere between 1 and 2 interest rate cuts. And this is all about the ongoing inflation conversation. So when we're talking about where's the risk, I think the risk is really lying on, hey, does inflation stay too high to the Fed's liking, keeping interest rates elevated and preventing companies from reaping the benefits of lower interest rates? Now, lower interest rates benefit a lot of things, whether it's the housing market via lower mortgages, whether it's small and medium-sized companies borrowing debt that's cheaper. And it also has implications on the federal government because they're having to finance their debt at higher rates now than what have been, seen over really the last 10 years prior to Fed interest rate hikes. Now, I think that at least from our perspective, we see kind of a continuing downtrend in the inflation trajectory. It looks like you're finally getting kind of the core services segment of inflation ticking downward. So it's looking like it's on the right trajectory, but it is a little bit painful from an investment standpoint, just having to wait on the next CPI inflation print, next PCE inflation print, because while the Fed is managing their dual mandate of maintaining the labor force, maintaining low unemployment, but also maintaining low inflation, it's really focusing on the inflation side of the argument right now. Luckily, this is a risk or non-risk that we can talk about as we go forward in the podcast. But the labor market really hasn't played into a risk for the economy. And whenever you're talking about, you and I were talking this morning about this, is that whenever you've had sustained drawdowns in the market, it's been because of some kind of recession. And what drives recessions? It's the labor market. And so if you have solid labor numbers, I'm willing to sacrifice a slightly higher inflation and slightly higher interest rates for a period of time in order to have a strong labor force. But it really goes back to, hey, as far as kind of medium-term price action, what is the Fed going to do? How high are interest rates going to stay and for how long?
Yeah, I think that's a good point. And even on an individual level, inflation is tough on a lot of families. What's tougher than inflation is losing your job. So
absolutely,
it's a dual mandate, but when you look at breaking one or making slow progress on another, I think the Fed's kind of where they need to be, making sure they don't break the labor market in order to get inflation back down, because inflation is moving down. But it's going to be a lot easier for people to deal with 3% inflation for the next 12 months instead of with a job versus maybe 2.5% without a job. So I think that's one thing. Props to the Fed for keeping it, kind of where it needs to be. But to your point of higher for longer, well, medium and long-term rates have risen recently. We finally have a very normal looking yield curve, with your short-term rates being your lowest and then rising rates as you get out in duration. And so that's partially, but mainly driven because we're expecting higher for longer. When everyone was expecting a bunch of rate cuts coming, next 12 months, next 18 months, well, the long rates aren't going to be that high because, okay, why am I going to pay you 5% for the next 10 years if I know, which didn't turn out to be true, but expect rates to drop considerably in the next 2 or 3 years? Like, that doesn't make sense. So that was driving an even further inverted yield curve. That's normalized as people have realized the Fed's going to keep rates higher for longer. It has hurt a lot of the, kind of your small, medium businesses that rely on debt financing more, but, that's been a big contributor.
Yeah. And I think the other half of that is really the US fiscal situation that we're in. The market is paying a lot of attention to this. We've done podcasts before talking about the fiscal situation becoming a bigger topic as far as market conversation goes. And that's because we're still at deficits that exceed any peacetime period in history. We've got debt that's reached, 100% of GDP or expected to surpass that very, very soon. And so you're talking about a market that's having to deal with the idea of, hey, the US is generating so much debt. One, is the market going to be able to absorb all of those treasury auctions? And so there's been no time in recent history have people really paid that much attention to treasury auctions, but all of a sudden now people are focusing on that. Hey, what's the demand look like for treasuries right now? Because the market has to continue soaking up all of that government debt. And how high is that going to drive interest rates, especially on that medium to long end of the curve? And so this is part of that conversation. It goes back to some of the government conversations that we've had. How much fiscal budget cutting is the Trump administration going to be able to do? You're also having to balance budget cuts with potential tax cuts, which means less tax revenue. Of course, that could lead to more future growth. But in the kind of medium term where we are focused on right now, it really is about that government deficit and how much that could potentially shrink in the near term, because it's definitely influencing the way the interest rates have moved recently.
Exactly. It's kind of interesting. You have what's referred to as risk-free debt. The US government's always been seen as risk-free debt, but the price action is kind of indicative of a company who has default risk, where the longer rates are going up because people just don't know if the US government's going to be able to pay their bills. And so, you're kind of adding a risk premium to the risk-free rate, which is, kind of interesting to me. Something we've talked about, we mentioned it prior, but is, the risks to the job market. There are kind of upside risks and downside risks. Those upside risks being job market continues to stay strong, something we've seen just so far this year. But having that prevent the Fed from cutting rates, I don't think that's a huge concern, given that it's still an inflation fight. So as long as inflation's coming down, they can continue cutting rates because they're not concerned about the job market. However, the job market turns south, then the Fed will have to cut rates to support that. That would be, it's both of these things are kind of mixed signals for stocks and for just stock markets in general, because it's kind of a good news, bad news. Is good news, or is good news bad news today? Because it all depends. Well, if the job market's doing poorly, that's bad for the economy, bad for companies, but it might lead the Fed into cutting more, or probably will lead the Fed to cutting more, which is going to be good for the rest of companies. So sometimes you'll see the markets act inverse of how you think they really should. And so it's been kind of an interesting environment to be in over the last, this has been going on for last year and a half, 2 years now.
Definitely. And I think what you really want in an ideal world is that Goldilocks data, where you're not too hot, not too cold. You're kind of right in that sweet spot of, hey, the job market's not going gangbusters, but it's also not in a precarious situation. So you want to have that medium thing, kind of territory where the job market's strong, but not too strong because of the interest rate reaction from the Fed. It was really interesting just this morning, as of the time of recording, we saw the jobs print for December come out. Well, that was very hot. And so the market reacted poorly. You would think under normal circumstances, more jobs are a good thing, but because of the interest rate dynamics, doesn't always turn out that way. Now, I think another area that's interesting as far as risks are concerned are geopolitics. Of course, when we think of geopolitics, you're talking about the national stage or international stage, excuse me. And a lot of times these are kind of black swan events, because if you're talking about, hey, maybe something happens in war with Russia, or China invades Taiwan, or you've got some other kind of serious geopolitical development, it's one of those known unknowns. It's these things could happen, but who knows if they actually will or not. Well, I think something that we kind of do know is coming forward is tariff policy from the Trump administration, but it's also unknown as to the extent of these tariffs. I think you're certainly going to get headlines around these that are going to move markets, but I don't see a, sustainable market trend coming out of tariff negotiations. Now, it could be some kind of medium term price reaction that may develop, but it looks like the Trump administration is going to kind of temper expectations for how intense these tariffs are going to be. So hopefully this leads to markets that can kind of be appeased by some kind of medium or moderate level of tariffs. And I think it is hard a little bit to get a grasp on the geopolitical situation just as a whole, because we don't know what's going to develop in the news over the course of a year, but it's certainly something always to pay attention to. I think one of the biggest things that's occurring right now is dollar strength, because our interest rates are staying high, because there's expectations for a booming economy here in the United States. The US dollar has gotten very, very strong, which means it hurts companies that are selling a lot to foreign nations because those dollars abroad are weaker compared to ours, so they can't afford to buy as much of our goods. So those exporting companies are going to struggle under a stronger dollar, and it looks like that's going to be a sustainable trend, at least for the near future.
Yeah, and then so geopolitics, you have zoomed out all the way. If we zoom into the more micro level, you start talking about individuals, and individual investor optimism is really high right now. It's been high for a while, and the tough part with that, while it sounds like a great thing, everyone's optimistic, everyone's happy, well, you have a very strong inverse correlation between optimism and subsequent stock market returns. So again, sounds counterintuitive, but when people are optimistic, that's a point where people are generally fully invested. They're tapped out. They're just sitting and waiting and expecting the number to go up. Well, if everyone's already at that point, then there's not really additional dollars flowing in. And so then as soon as there's a concern, a risk, a really good jobs print like this morning, lots of jobs added, and people see that as a threat, then you have a lot of selling because everyone's already fully invested. So there's kind of one direction to go. I think that's being a little dramatic about the situation, because, we can still continue to make positive progress despite investor optimism. But that is something to watch out for, because people have been very optimistic recently about future prospects for the S&P.
Yeah, absolutely. I mean, at the end of the day, stock prices are still a function of supply and demand. How many shares are out there on the market? Well, that's staying relatively fixed, right? So it becomes how much demand is there from investors to buy these stocks? Well, a function of that demand is how many dollars do you actually have? Well, if you're already positioned your whole portfolio in equities or fixed income or all of these things, you're fully invested and you may not have as much cash on the sidelines. Well, even if things go well, you don't necessarily have additional dollars to put there. Whereas, say you're super pessimistic in a period where investors don't feel so good, they may have a lot of cash on the sidelines. And then as soon as you get a positive headline, money starts flowing into the market. So we do think, we still maintain that we're reasonably bullish on the current market, but because equity positioning is high right now, it does leave the tape somewhat vulnerable to those adverse price shocks like you just mentioned.
Now, these are some of the most important topics that we're looking at and watching. Like I mentioned at the beginning of the episode, I don't think we're concerned that any of these are immediate threats to future price returns. However, they all could be if things materialize differently than what we currently expect them to, or if things change. Something I think I'd invite our listeners to do is, if they have anything that they're concerned about that we didn't list here, we can look at it, talk about it on a future episode, or even just consider it for our sake and everybody else watching. I think that'd be a really interesting thing, because this isn't an exhaustive list. These are just the headline things that we're looking at, saying, hey, this could be a real impact to the year going ahead.
Right. And that's why I think it's also important that we're addressing some of the risks in our sector by sector analysis that we've been doing on multiple podcasts at this point, talking about the individual sectors of the economy, because it's much easier to talk about what risks are actually going to impact a sector versus the broad market. Broad market's going to be super macro in scale, going to be those, the Fed, inflation, interest rates, job market, things like that. And I think it is somewhat telling that our list today, at least for broad market impact, is relatively small. I mean, it's still a lot the Fed, it's still a lot about inflation, about interest rates, but these are kind of the major risks. And so as an investor, you feel pretty good knowing that you're not going into an earnings recession, you're not going into a labor market recession. So the question is, where are interest rates going to go? I mean, that at least leaves us at a pretty good point. But just want to outline these because if you're watching Bloomberg, if you're watching CNBC, these are what people are going to be talking about a lot. And so just having some insight into that, I think is exactly what we want to provide our listeners with.
Yeah, exactly. Thanks, Victor.